Okay, so let's talk about big lots. And I got to tell you, what interested me in this stock was originally it's cheap. I mean, it's trading at this. I'm doing. Yep, it's trading at I want to say an EV to EBIT of 2.5. It's cheap, and 2.9, excuse me, which puts it at what an earnings yield of 34, almost 35%. If you want to calculate it the other way, the inverse of PE, 40% earnings yield. Now, it's lovely. But you got to wonder, why is it trading so cheaply? Because there's a reason for it, especially in 2020. All right. So that's what initially got me interested in the stock, because I realized it's cheap, but it doesn't make sense why it's cheap. Everything is cheap for a reason, especially in this weird COVID stock market. So what I had to do for this was a few different things. I had to switch out this would have been day sales outstanding, but that requires accounts receivables. So I switched to day sales inventory, because as you can see on their financial statements, they don't have accounts receivables. Nothing. Inventories, accounts payable. That's it. Now, the larger problem that you have is, how do you calculate working capital without accounts receivables? Well, you got to switch to the accounting way, which I don't like, which would just be current assets minus current liabilities. And as you can see here, this is about 10 years of financial data from 2011 to 2020, their most recently filed 10K. Working capital has been on the downward trend for a good chunk of time as they take on more and more debt. Now, the problem with big lots that I'm noticing are a few things. Let me just shut this thing off. Are a few things. One, and I'll just make it easy on us. On page 43, you notice for their merchandise inventories, they record a reduction to inventories and charge to cost of sales for an allowance for shrinkage. That's not good. And they've mentioned it's a good chunk of what they do, and it's a headache. Gross margin, as I mentioned on page 27, decreased 0.3% compared to 2018. And they mentioned here the gross margin rate decrease in 2019 was due to a $6 million impairment of inventory in their greeting cards department, which they left in the first quarter of 2019, and a higher markdown rate from increased promotional activities and a higher shrink rate compared to 2018. So for those of you that don't know, inventory shrink is people getting handsy at the locations and trying to make off with some product for free. Obviously, that's going to lower gross margins, but it tells you the demographic that Big Lots tries to deal with. Okay, so you're probably dealing with, let's just be honest here, lower income people that tend to be the demographic that they seem to go to. They tend to be in lower earning areas. Same with Kmart. This Big Lots kind of reminds me of Kmart. It's not a bad thing, but I will mention that with inventory shrinkage, some of the larger stores don't really have that much, maybe not have as much of an issue with it, but Big Lots leads with the fact that their gross margin is shrinking because, and in part of inventory shrink. So it's a big enough problem to where it starts to eat into their margins, and that's a big issue. You would think a company of this size would be able to deal with shrink at a much more meaningful way, and apparently they haven't. Now, another problem with Big Lots is that they've been aggressively buying back shares. Now, while that's all well and good for shareholder returns and is very shareholder friendly, um, it definitely kind of juices up their earnings per share. And I haven't adjusted on this sheet. I haven't adjusted earnings per share for the buybacks. What I did for this was I added the buybacks back into the total share count and acted as if they never happened in the first place. And the reason I'm doing that is because I want to try to figure out what their capital base looks like without the share repurchases. That way I can see if they're trying to dilute shareholder returns or if they are diluting shareholder returns. So from here, you can see at 2011, they had 78.5 million shares outstanding all the way down to 2020 when they had 39 million shares outstanding. They are buying back shares at a very, very aggressive pace. But what you'll also notice for these 10 years, the gross profit margin has been rather high. The unit economics of this business looks very, very good. So they tend to catch a very large percentage of the dollar that goes through their hands. Now, it also seems to be very profitable growth as well because net revenues and gross profit grow in line and decline in line. It would be very worrying to me if net revenues grew but gross profits didn't. Then that would signal to me growth is not profitable after a certain scale, but Big Lots seems to work at scale. Or the unit econ is friendly at scale. So they go up. And I think they're sitting at 1,401 stores. We can actually check that. 1,404 stores in 47 states. So it works at scale. And the unit econ is favorable, which I want to pay attention to that, obviously. But what you will notice here is that operating expenses, namely SG&A, and that's how I'm throwing it in there. Operating expenses have also grown and outpaced the growth of gross margins within the same amount of time. So what I'm going to do is I'm going to highlight that just to keep that in the purview. I'm going to make that just a bright color to show where we need to be looking. So you can see here SG&A and OPEX, has grown 1.63% over the course of these 10 years. And EBIT margins have not. They've actually shrunk, negative 1.5% over the same time. So it sounds maybe there's an operational issue with the company, but it doesn't seem like the unit econ is bad. It seems to be a good business. And so for those of you that don't know, Big Lots is closeout retail. It's what TJ Maxx and Ross stores does, but like at a larger scale. And they do it with furniture. They do it with home electronics. They do it with home decor. They do it with a lot of larger scale things. And they have suppliers overseas as well. Their margins are very, very, very good. However, they don't really seem to. It doesn't seem to forgive them a whole lot because EBIT margins have not been pacing up alongside the growth of OPEX. And I'm going to skip to sheet 2 here to kind of single out some of this stuff. So EBIT margin has, once again here, before any of the adjustments I've made, EBIT margins have been on the track down. Same with ROA. And ROE, cash ROE, and on sheet 1, you'll have all of this outlined for you at the bottom of the spreadsheet. I have this highlighted in red. The 2020 EPS, I have it highlighted in red to show this is kind of what signaled to me, okay, this doesn't make any sense. This does not look right at all, and it's a sign to dig deeper. So out here, I've calculated all of these metrics and then the relative compounded annual growth rates for this entire time period. So what I want to show is for Big Lots, the standard deviation and median of EBIT, ROA, and so on and so forth that you can see here, and their variations of them. So for this time frame, EBIT variation doesn't seem to fluctuate all that much. It seems to be pretty low, which would be great if EBIT margins weren't dropping. Now, this is for adjustments. So they've had some pretty annoying accounting for the past 10 years. So in 2020, they sold off their Cucamonga, California location, and they relocated to Apple Valley. So what I'm going to do is I'm going to show you this on the financial statements here. Gain on sale of distribution center, 178.5 million. So what I'm going to do, I'm going to show you how much of a percentage of EBIT that is. So 178,534 divided by 242. Excuse me, that's net income. Excuse me, 334,826. All right, and you're going to multiply that by 100 to get 53.32%. The gain on this sale was well over 50% of their operating profit for the fiscal year of 2019. That is atrocious. How are they going to do it again? They can't sell the same business. They can't sell the same location twice. They can't do it again. So right out the gate, this should be a huge red flag, and in my case, it was. Now you can add back, and what I'll do is pull 178,534 out of EBIT, so you get an operating profit of $156,292,000, and you get a net income of $63,930,000. Maintain that against the diluted share count, and I'm getting that here. Then you get an EPS of $1.62. Not 616. Okay, so now we can be more generous and we can add back. We can add back the depreciation expense. You still get an EPS of $5.05, but even then, that's still a rather large drop from this 616. The problem is that most people are just gonna ignore all this, and that's not safe. So over the course of 10 years, they've had some discontinued operations when KB Toys went bankrupt. So you got to pull that out too, because it's one-time expenses. They can't do this again. So what I did was I went through, I took their operating profits, and they've had multiple restatements over the past 10 years. So it is a little tricky to follow it. And so, I did the best that I could with this. So following me here, hopefully you'll notice that depreciation has become a larger and larger and larger expense for the past 10 years. And then I add back depreciation to EBIT. To get an adjusted net income number. And even when it's adjusted for all their accounting annoyances, and pulling out the one-time expenses and revenues that are the discontinued operations, and they end in 2017, you still have net income dropping from 2011 to 2015, and it kind of surges back up from 2015 to 2019, and then just tanks in 2020. So I don't know what's going on with this company, but it doesn't seem to me that the issue is the econ side of the business. The issue seems to be management. And I will mention here that you want management to know how to execute. And the most recent hire for the CEO position was Bruce Thorne. And that should raise some red flags because he just left Tailored Brands, and Tailored Brands went bankrupt. Joined Big Lots in September of 2018. He also held a lot of higher up positions in other large companies, and all well and good. I'm sure he's a brilliant man, but that Tailored Brands one is hanging over him pretty heavily in my eyes. And he's only been with the company for just 2 years now. So all the more power to him if he can make this work, but I don't think he can. So what kind of solidifies it to me is that EBIT margins have been dropping over time, as you can clearly see here, from 8% down to 2.94% in 2020. But SG&A costs, I should have them on this sheet here, have risen 1.63% over the same period. And that's a bit of a headache. So to me, it seems like it might be a corporate issue rather than a unit econ issue. And I don't have the money to go on an activist bent to try to fix the company. I'll leave that to better hands and better minds than I. So what I did was I pulled out the buyback costs. I assumed that the business is going to stop doing buybacks, and I will behave as though they never did buybacks. So what I did was I took the total share count that I had listed in sheet 1 over here, and then I added back the amount that they said they bought back over the course of these years. So in the case of 2020, what I'll do is try to make this a little bit quicker. They bought back 1.3 million of their outstanding common shares. So I pulled that out and I added that 1.3 million back to the outstanding share count that I put in sheet 1. And then listed the buyback cost as shown on the statement of cash flows. So in this case, I took payment for treasury shares acquired, 55.3 million, took that number and then added it back to shareholders' equity or book value. So I took that and then I took the buyback cost in dollars and I added it back to book value to get the adjusted book value. What I'm trying to do is add the cash back into the business to the equity account as though the buybacks never happened. Now, I have no idea if this is the right way to do it. I will admit that wholeheartedly. So if someone is smarter than me, well, more than likely you are if you're watching this, please correct me if this is not the right way to do it. And if it is the right way to do it, please let me know, because I am lost. And I admit that, but this is the way that I'm starting to see the company now. And the process, though tedious, is intellectually crushing. So what I did with this adjusted book value number is I added it back to calculate out capital and the adjusted capital base for the business. What you end up getting is, and I'll just do this. And you can see that it's grown. I have it on sheet 4, but just to show the growth of this adjusted capital base is CAGR, as if the share buybacks never happened. The capital base has grown 6.62%, and EBIT hasn't, it's shrunk. ROIC hasn't, it's shrunk. ROE hasn't, it's shrunk. But SG&A grew, and also free cash flow. And this is going to be a fun one. So we already know that EPS has not, even when adjusted for shares, and I'm going to do it right now just to show. Even when it's adjusted for some of the accounting stuff that they've done, still hasn't outpaced the growth of their capital base, assuming the buybacks never happened. Now, if you treat the buybacks as and just say, okay, well, the shares have been bought back, what do you do with that? Well, I'll still say, all right, even if you did just say, all right, the buybacks happen, how is EPS growth compared to the growth of their capital base regardless? Well, in that case, you're solid. It's grown a small amount. However, I will say it makes the company more dangerous because reducing your cost, it reduces your cost of equity. Share buybacks reduce your cost of equity, so it leverages the company more. But because it reduces your weighted average cost of capital to a point. So now the company is more debt than equity. So they get to reduce shareholder returns if they want to do a capital raise, and it's going to shoot them in the foot because they bought back all those shares for a purpose. Now, the company is much, much, much more levered, as you can see. Debt has almost doubled in the past 10 years over their assets. So this company is increasingly levered, and the share buybacks have reduced their cost of equity, but it's made their weighted average cost of capital more in line with their cost of debt. More so heavier weighted towards their cost of debt than cost of equity. So now what I'm going to do is I'm going to pull up free cash flow in the way that I accounted for it. And so I'm making it simple. I just do CFFO minus CapEx, but also that they've had acquisitions, and you should be counting acquisitions as against free cash flow, because what do they acquire companies with, or what do they acquire things with? Cash. And it comes out of that extra money that they had from their operations after CapEx. So what I did was I did two things. I did it including CapEx and PP&E sales. As you can see here, I added PP&E sales back to CapEx to try to get almost a net CapEx number, something along the lines of net CapEx. So buying things, and maintaining and growing PP&E minus the sales, or adding back the sales to try to get to a net CapEx number. So I did CFFO minus acquisitions minus CapEx plus their PP&E sales to try to get to a net free cash flow number, which is a weird thing for me to say because I'm still trying to process it. And you can see if I do it that way, that free cash flow has just been all over the place, but has ultimately landed at a 2.65% growth rate for these 10 years. Now, if I just do it as CFFO minus CapEx minus acquisitions, free cash flow is tanked. As you can see, and when I say AFCF, I mean adjusted free cash flow, meaning CFFO minus CapEx minus acquisitions. So now the problem here is their capital base has, if you take out the buybacks, has grown. And the problem is that they're diluting shareholder returns because EPS hasn't grown faster than their capital base. Their capital base has grown 6%. EPS hasn't. When adjusted for all their accounting headaches, EPS has only grown 4%. Their capital base has grown 6%. So they're diluting shareholder returns. And the problem is that they are not able to affect their free cash flow any better because their days sales inventory is increasing. So I'm going to go back to sheet 1 and show here the day sales inventory, and I show the calculation here. Ending inventories divided by net revenues multiplied by 365 days in their fiscal year has grown from 56 days to 57, 62. Went down, went back up, and it's on the path back up. This 67 days outstanding is shocking, but it's grown ultimately at a CAGR of 1.31%. That's a problem. Now, it kind of makes sense considering what Big Lots does, because they sell furniture and home decor. That's where they make a lot of money. And not everybody's going to buy a couch day in, day out. That's a bit of a problem because in 2020, and we're facing down a potential resurgence of COVID, unfortunately. So now you have a problem of how are they going to be able to flip their inventory when no one really has a whole lot of extra cash, stimulus money doesn't look like it's going to come back anytime soon, or at least when it matters. And you still have supply chain issues. Where are they going to get the furniture from? And who are they going to sell it to? They already can't really sell their inventory. So what are they going to do with this growing glut of inventory? And they can't sell it all that much. So what are they going to do to get rid of it? And the problem is they might have to do consignment sales or cut their margins in half, which neither of these are desirable options. They could do a capital raise, but that ruins the point of share buybacks and acts like it never happened. Management's kind of backed themselves into a wall here. And what I like about Big Lots is that it's a profitable company. It could be a very, very good investment if management knew how to execute or not back themselves into a wall with share buybacks. And this is kind of the danger of being too shareholder friendly. I mean, we've seen the dangers of companies not being very shareholder friendly. Poison pills and not talking to investors and trying to just ignore investors outright, so on and so forth. But in this case, it's being a little too shareholder friendly and noticing that their capital base has grown faster than anything else that's actually important. EBIT hasn't outpaced the growth of their capital base when adjusted for buybacks. ROE and ROIC haven't either. I don't think this is a company that could create value for shareholders right now. I think you would have to get in management that can execute properly. And I'm going to keep looking into this company because I think this is the first time I actually found a company where I realized why it is cheap. And recognizing that some of its competitors like TJ Maxx and Ross, for example, I don't think they're direct competitors. Just because TJ Maxx and Ross do more easily sold retail. Big Lots kind of functions as like half furniture, half TJ Maxx and Ross, and they seem to not really be that good at both, considering EBIT and ROIC have not grown faster than their capital base. They haven't even grown faster than SG&A. So I think this is a company that could be a very good investment if you see management start to change around in the coming months to coming years. And I think COVID is going to give them a lot more difficulty. Thank you for watching. Please comment, critique, like the video, and thank you for watching once again.